Good day, traders. Sorry about that slight pause or slight delay, rather, not a pause. Interesting morning in the market so far. I just want to share something with you quickly. This is just a screenshot of some trades that I was in as of today. I have closed these trades because of potential pullbacks. Now, on S&P 500, I was in a short trade just off this level. We'll look at this. This is now a screenshot. So we'll look at this actively in the charts just now. So I was in that trade and I scaled into the position here. And just as the market was, this was a screenshot before the market turned, but I have exited that trade. Hang Seng 50, took a trade here just before the close. Good enough gap down, and okay, I'm out of that as well. UK 100, so there was the trade. So the trade was at the open, and this is quite interesting. So we'll have a look at that open and the reason for me taking the trade and why I took it there and where my stop was. And then, we had this big pullback. So I kind of let it run back to break even, because as it was pulling back, I thought the bears might come back and defend the low of the first candle. They didn't, with bull candle breaking above, breaking back into those lows above that level of resistance, above that. So I just let it be, because my stop was still up there. But when you pull back and I was back in profit, I closed the trade. So there is or was the entry, and this is just 50% pullback. So again, we'll talk about that. Euro versus dollar, I sold here. 9 o'clock. It was a bit earlier. At the European Open, when the European markets open, which is an hour before the UK markets open. So I had sold there and pulled back, but no problem. I'll show you where I had a stop, at a wide stop, just above the high of yesterday. So, the pullback was not a problem. And if you hadn't taken that, of course, you would have had to look at jumping here. Very rarely do I scale into losing trades. You can do that as a strategy. That's perfectly fine, especially if you're jumping into the market, like I do with my first trades at 0.25. So if you took that trade and the market pulled back and gave you a reversal pattern that you're happy with, you could always scale in again at 0.25 with a view to get to your first entry with profit on that and hopefully get acceleration. But I do that rarely, 5% of the time. So I just let it be, trusting on my stop, which didn't get hit. We came back to break even. And this is one of those things which I repeat quite often to traders, that if you take a trade, let's say you've taken that trade, you always have an option. You can quite legitimately put your stop, your take profit order at the lows, next level of support. And this pullback turned out to be profit taking. Or you can hold on to the trade. I like to just hold on to the trade and see if there's always a little bit more. So if you banked your profits there, perfectly legitimate for you to have done that. And if you held on a little bit, now I held on to that trade, and I got out a little bit afterwards. So this screenshot, I just took this before. I could see some of the pullbacks which I wasn't comfortable sitting in until the show had started. So I wanted to just show you guys some of the trades. Hang Seng 50 is interesting. So we're going to look at these charts now. Talking about Talking about things I rarely do, but I do them, but I rarely do. This is one of the things that I rarely do. If I'm not already in a trade before the market closes, I'm saying 50, 3 sessions, morning, afternoon, evening. So this was the end of the, for me, it's a morning session, but the end of the afternoon session before it opens again for the evening session. And I was waiting literally for the last of that 5-minute candle. I waited right up to the last minute. Got a couple of accounts I was trading. I had the order tickets ready. I had my stop in place, and I said to myself, if this ends up as a bear candle of any sort, I'm just going to sell at the market, put my stop in, and I'll show you where I put my stop in into the market and why I did that. So I sold that, opened with gap down. I was hoping for more strength. Okay, that would just accelerate and drop. The market just drops bottom, gets all the way down here, and I make a fortune. It never happens like that. But I was happy enough with that. And when I thought, oh, the market is going to reverse, weakness by the bears, let me get out. So for all the trades that I took, I mean, the sum total of it, you know, I'm happy with the return. You know, 5 trades were in. Where is S&P 500? So there's one trade here, one trade S&P, Hang Seng 50, one trade euro versus dollar, one trade UK 100, 2 trades on S&P 500. So all the trades turned out, they were profitable trades. So I'm up quite happily. Yeah, that's the number. I'm up quite happily. Plus some of the earlier wins on the Hang Seng 50 earlier on. So we're going to go through that. You know, I wanted to show you the screenshot. So I'm going to talk about the trades and the logic behind them shortly. So just keep these in mind. My apologies, guys. I didn't open up my YouTube. I just want to make sure to see if there's any questions. Give me half a second. Sorry about that. It will not take time. So this is just quickly letting the other traders come in. Well, they're already in, but in case there are questions, I always like to make sure I answer everyone's questions. Okay, apologies for that. So we're going to go, just stop this particular share, and let's go into the actual charts. Okay, so I took the screenshot. So now here the market is live. I took the screenshot. So you can see what I was trying to avoid is all of these, well, not trying to avoid. I didn't want to give away profits. The reason for that is when I took all the short trades based on the structure, I was expecting bear acceleration down. Okay, which means I wanted to see successive bear candles. And when I don't get that, then a pullback is imminent. I don't know how deep the pullback is. I mean, I allowed this pullback to take place on the UK 100, thinking that the market would turn and accelerate down. And I got out, I think the trade was here. So I got out of that with a bit of profit, and everything else was profitable. But you can see the pullbacks that I didn't want to allow taking place. So let's have a look. A little bit more detail. So this is euro versus dollar. The market opened here. I do this quite often. I haven't done it. So when I say the market open, the European markets, when the big exchanges open on the European continent, German, France, Italy, all of those, that is that candle, and that is happening an hour before the UK markets open. And those were that was the UK markets open. Now the question then is, why did I sell? On what basis did I sell? Let's go to the daily to explain that. So there is a daily chart for the euro. Now remember, while I actively trade the 5-minute chart, I'm always looking at the beginning of each day without fail. This analysis of my daily chart is as rigorous as if I was trading the daily chart. So I'm always looking at the daily charts because I'm trying to find the higher probability momentum. So I use all of these words it helps me feel like I'm pretty smart. So the higher probability momentum, higher probability direction, that's what I'm trying to find from the charts. Just say, okay, this happened, what is likely to happen? On Monday, so this was Monday's candle, I was a guest in Trading Buddies, and I was saying, while I still think we are in a bear market, but the fact that the bulls had this strong bull candle, everything is still bearish if you look at the chart. I'm expecting momentum. I mean, the bulls who created this for whatever reason, there has to be a little bit more momentum in the market. So when I go into the market, I'm looking for ways to go long and get bits and pieces. But now when we get to these levels, which I said, based on price action, all of this is indicating that we are still in a sell zone. The bulls managed to break out of this long-term channel. I mean, this channel, we've spoken about it quite a bit. It's just literally for the whole year. In a bear channel. Okay, so the bulls managed to break out above that. But they haven't broken out above that. That's where they broke out above that. Their biggest problem was parity, and is still parity. 1. Euro is equal to the dollar. 1, parity, big round number. Excuse me, and every time you have big round numbers on your price axis here, you must always just plug in the level of support resistance. So big round number, you can see market oscillated over that. But over and above that, I want to sound a little bit repetitive, but I think it's important for us to understand these things or to see them. You can't even see it on the daily. Let me put it on the monthly chart. So if you go to the monthly chart for the euro, the last time the market was at parity is 20 years ago. Now, anyone in the market, anyone with the mildest form of interest in financial markets, whether you're just an ordinary guy going to work and doing your stuff, and you're kind of dreaming of a holiday at some stage anywhere in the world, all of a sudden say, but hang on a second. I don't have to try and buy dollars to have a strong currency to go on holiday, because look at this. The euro is as strong as a dollar for the first time in 20 years. I mean, 5-6 years ago, we were trying to get to it, but the bulls came back and pushed the price away. This is a huge event for price action traders. It's a huge event. It's as huge as as drawing a trend line and saying, my goodness, look, the market has now hit a trend line for the first time in 2 years. Something is going to happen. And that's exactly what's taking place here. Something big is taking place. And you cannot ignore that. So if you go back to the daily, even though they broke above the long-term bear channel, the biggest problem was not even the channel. At this point where we are was the parity. So tried to break above it and failed. I mean, this is as beautiful and as clean a 2-bar reversal as you'd ever get. If you just saw that, if you trade in the daily chart, just put an order beneath here, boom, get your 1-to-1, get out, bank your money. If you see this on any chart, anything like this, and you're looking to go short and the structure is right, just sell. Place an order, decide where to put your stop and leave it. Well, you might say, George, why is there a doji afterwards? Well, there is a doji because as certain as we may be, at best, we are 60 to 70%. So even though that's beautiful, you gotta go in and saying, I'm gonna put a stop in here or measured move, or maybe not even measured move. If I don't put a stop here, I can put a stop right here. Okay, that's the next technical level. Because no matter how certain you are, there's someone who's going to go the other side. So hence we had a bit of a pause, probabilities, but they worked out in our favor. Then when you get to the 1-to-1, just bank your profit. You know, don't try and wait for more. In any case, huge bull candle, we spoke about it, and bulls came back in. And when I saw this, I said to myself, well, this is interesting because remember, as a price action trader, there is no such thing as noise. Noise does not exist. Every little bit of information that the market shows us tells us a story. So the story here was bulls were creating a follow-through, breakout above parity. In order for the breakout to be successful, for the market to say, oh my goodness, the bulls are about to take over, all they had to do was to give us a close above this new descending trend line, that lower high, and they did. And plus, big plus, they had to close above this 2-bar reversal. Just a tiny little bit of a close, not a failed breakout like that. So when they failed to break out like that, it shows that the bulls, I mean the bears who created this 2-bar reversal, are still defending the market here. So if you trade in price action, as you're going into the market, you must look for the bearish momentum to see if there is continuation right from the open. And so on the back of that, I was quite happy to take a short. Does not mean that the day is going to end up as a bear candle. Okay, so took the short, banked the money. I'm going to keep watching it. If the bears come back in again and start to sell off, we jump in again and just sell with them. But if the bulls start to reassert themselves back on the 5-minute, well, we'll look for opportunities to go along. As it stands at the moment, although the bear breakout is weak, something that I think you're kind of getting used to. So there was the low somewhere in that region, and there was the high. So the bears, their objective was to get down here. So in my trade, my anticipation was, hey, bear breakout, pull back, and they're going to accelerate down and get down here. But we didn't get that. So instead, we started to go sideways. 3 attempts by the bears to break out beneath this level. This level is a key level. It's a midpoint of yesterday's range. So one of the things that we always mark, so the 3 things we want to mark on our charts is the extremes of the day, so the high of yesterday, low of yesterday. high of yesterday, and the red line down there will be the low of yesterday. Or make it 4. So let's break it. High of yesterday, low of yesterday, and then the midpoint of yesterday. Remember, yesterday is gone. It's a whole trading range. It's just like if you work in, you trade, and all of a sudden there's this huge candle that just appears. Big bull candle, a big bear candle. And you look at your news and you say, I didn't miss anything. There's no news announcement, but it's happened. So just call those surprise candles, right? It's a surprise. At the moment you have a surprise candle, or you've stepped out of the market because there's news coming, there's red news coming, or it's at the open moment you have one of those big candles. I'll see if we have time to have a look at a few that characterize Hang Seng 50 these past few days, huge candles. What you do, you have to mark the midpoint of that candle's range, just like we mark the midpoint of the previous day's range. So 50% midpoint range of yesterday. That's that level that we've got there. So that's the third thing, high of yesterday, low of yesterday, midpoint. Then when you have the highs and the lows, you use the same Fibonacci tool, your Fib retracement, and you just extend the measured move. So if you're anticipating that the bulls are going to take over the market, you want to see where the measured move is. Measured moves are extremely accurate. Yesterday I was talking to, last night, to one of my clients from that other side of the world. You guys are on that side of my world, the right-hand side, plus 6 hours. He is minus 7 hours out in Jamaica. And he's saying, man, I'm getting it. After a whole year of talking about it, I'm finally getting it. The precision and the accuracy of measured moves is absolutely astounding. The market looks at that. Why is it? Because whenever a market breaks out above a certain level, the initial target, guys, let's see if we can get to the same extent, same one-to-one level. And of course, all the programmers do that, so it's in the computers. So the whole genetics of the market structure. See, there's another use of words that makes me feel like I'm smart. The genetics of the market structure is structured around measured moves, or try to get measured moves. So you really just have to put them in. So measured move extension of the day, which means if you're away at work, for example, or you only come into the market towards the end of the day because of your time frames or where you're trading from, and you've got that measured move, and like, hang on, there's still few hours to go of trading, but the market has hit a measured move of the range of yesterday, then you have to gear your mind to look for possible reversal patterns, because it might just create a reversal pattern and try to come back to test other levels, and you can take advantage of it. So just something to bear in mind. Quick one, here's one. So that breakout, pull back. If you said, well, how far is the market likely to go beyond here? Look at that, as precise as they come. There is a measured move. If you see a lot of overlapping candles, I've mentioned this before to guys, you can just, wrong one. I can't believe I used to trade bars. Can you believe it? Used to. You can always use the line chart. The line chart shows you the closest measured moves, because it's based on closes, not on extremes of the candle wicks. So just based on that one we're measuring there, so about there. So there will be the measured move back to the candles. And that measured move would have taken the base just below the midpoint of yesterday, but you got a wedge bottom, get into that. So based on that structure, just get out of the market. if you've taken a trade here. Now, when I took the trade, I had a huge stop. So I kind of said to myself, I had all of, so this hadn't taken place. Okay, so let's remove it. So all I had at that point, I'm right at the low of the day. There is this descending channel line. Remember this line here, okay, the descending trend line, which is a level of support when the market above it, and then resistance, and we oscillating around it. So I had that, and I thought, well, bulls tried once, tried twice. Nothing stops them to try one more time to get up here and create a wedge pattern and then sell off. How quickly could they create that? They could create it in one huge candle. Excuse me, if you flip, I mean, this is UK 100s. Okay, so it's possible to have those huge candles. Have a look at this beautiful picture that if you're looking at Hang Seng 50, I mean, that's one candle. I mean, this thing formed. I didn't get a setup in here. We probably won't have time to talk about it. But this thing formed. And I'm saying, wow, look at that strength of the bulls. I mean, it went past the measured move of the first candle. It broke above the high of yesterday. And that's how far it got to. And then while you're watching it, it just pulls back. Bears come into the market, bears come into the market, eventually closed there. And bulls tried to jump in again to the market and they failed. And I jumped into a short there. Is that 2-bar reversal. I mean, market went up and came back. And I sold there. I said, well, bears have sold off here. And there's followed through. I can put my stop above there. You don't have to have taken that. You could wait for that particular trade and put your stop, midpoint. So you could put your stop midpoint of this range. Then you look at the nearest technical level. You can just put it above there. And why would you do that? Or what are you hoping for? What you're hoping for is this precision of the measured moves to work again. So there is that surprise candle. And the measured move is here. And guess what the market hit? Boom, measured move of that. And you just happily bank your profits. You take that trade. When it reverses, you can exit. When you come back to the midpoint of that expanding triangle, you sell again. So it's been, so far, a good morning. So based on that, remember, I'm trading this open. I can't see all of this. But I'm saying now, based on my daily chart analysis, it is possible that the market can sell off. It's a low probability trade. So a low probability trade is 2.25%. So always when I'm jumping into my reversal trades, 0.25%. Low probability trade just simply means for me, when I look at where I can put my stop instead of technical levels, I want to go as wide as possible. So if I'm taking that trade, hoping that the bears that are evident on the daily come in very quickly and reverse the market and sell off, I don't put my stop here or here. I look at the next technical level. There is this level here, which was micro double top. So that's the 2-bar reversal that I showed you, that high. And there was the high of yesterday, which just went a little bit above that. So I put a stop pin. My largest stop is like a 60 pip stop. So it was in the stratosphere, full high risk. So on euro, 0.25% largest stop is 60. I've got all, I think I've shared this with you guys before, so I don't want to bore you. In terms of largest stops, just to see how it works. On Hang Seng 50, in terms of the quantum, my largest stop is $100. And again, I said 0.25. UK 100 is $40, 0.25%. S&P 500 is $20, 0.25%. That's the kind of like, I keep this handy because sometimes the market is moving fast. I just want to do, a quick view of it. And let's say I was taking trade here and I say, oh, that's about 25. Okay, I must go into 40 pips. Just look at my charts, boom, put it in. So I'm not wasting time opening up the calculators at all given moments. So we didn't get the acceleration. That's perfectly fine, but I had no problem because I thought maybe we might get one of those huge candles that tries to create a wedge. So just waited. And then at the open of the UK markets, I thought, oh, okay, maybe this candle, the measured move, was going to create that wedge top, but we didn't get there. If it had done that, whether it's that candle or follow through, would not have been a problem because it's something that I had anticipated and the stop was way above that. In any case, if I had not taken any of these trades, this trade, for whatever reason, just decided not to take it, let me wait and see if I can get a better entry when the market opens. If you'd seen this kind of structure, remember you'd have done all of this analysis. Seen this structure, first candle, follow through, closing above the open of the day, which is the magenta line, and good follow through by the bulls, and not sure how far they'll go. Kind of say the measured move of the first candle is up here, so they might put a couple of candles. That's perfectly fine. Let them do that, and we can wait and see whether we get a reversal. But then you get a bear candle, and it's like, well, that's interesting. Where is the momentum by the bulls? We get a doji candle, another bull attempt to break out, but end up as a double top, and it failed. So if this candle here, so if this candle here had closed near its low and just below the open of the day, you could take that trade, put a stop beneath that, and where is your stop going to be? Well, you can do a measured move of that, but you already know that's measured move. The first candle, there's a potential. So this wedge top would potentially have been there, which is almost where we were. There's this level of resistance, that 2-bar reversal that we saw on the daily. There's a high of yesterday. So if you've taken that, your nearest technical level is here. That's where you got to put the stop. So that stop would have been, if you're taking that, somewhere within there. Call it 30 pips. So this stop, 30 pip stop, would be half of the stop that I took at 60. Perfectly fine. But bit of caution. I mean, if you're taking this kind of candles, must close on your knees slow. But there's always a provision that if you decide to take it, because things are moving fast and you're trying to determine, if you decide to take it, just make sure your stop is at the correct level because you might get more pullback. So there's nothing wrong with it. Okay, you just want to wait for a little bit more certainty. So if you leave that, market's gone up once, gone up twice, it tries to go up again. This is a good enough candle for the bulls. If the bulls were strong, then they would accelerate above that. But they failed to accelerate above that. And they give you another opportunity. So now you have a micro wedge. So there's another reversal pattern. So if you really become good at these reversal patterns, you'll see so many opportunities. Other day, someone said to me, so what kind of a trader are you? I said, no, I'm a price action trader. They said, no, what do you trade? And I said, well, I'm always talking about reversals. Even my capital allocation is based on reversal strategy. So I'm actually a reversals trader. Okay, so I'm trading reversals into trend. And then when the market pulls back, that's a small trend. I want to look for the reversal back into trend. So if you really pay attention to these patterns, you start to see, the wedge tops. You start to see the second entries. There is the first entry, second entry, third entry. You start to understand these wedge tops. Start to understand these levels of resistance and this confluence areas where you have these nested patterns. That when you see that, I have to take this trade. There's no reason not to take it. If I get stopped out, that's fine. That's the third arm of the trader's equation. Remember, the trader's equation is three parts: risk, reward, and probability. Risk you've taken care of, 0.25% is the amount, and you know where to put your stop. Reward, you can decide, I'm going to take my profit at the bottom here, or I'm going to manage my trade to try and get more. And then probability, who knows? Risk, reward, probability. All we know is if we look at all our patterns, we get a higher probability in our favor. So work on 60%, not 100%. And I'm going to take the trade, but it means out of 100 trades, 40 will go against me. I don't know which 40 I will lose. I don't know which 60 I will lose. Random distribution of trades. All I know is that on the 40 that I lose, if I've got my stop in the correct place and I see market accelerating up, I can wait for my stop to be hit, or I can just close my trade at even less than the 0.25%. So we manage our trade in that way. So you have taken that trade, put your stop there, and then just wait to see what you get. When you get here at level of support, it's not wise to initiate trades. You don't know this is going to happen. Unless you've already banked some profits from earlier on, you can't sell directly into a level of support. Market can just bounce and stop you out unnecessarily. So if you've missed it, you've missed it. But if you are in it, then you are in it. So for Euro, as the day unfolds, my thought is still bearish. But now I would need to wait. The best place for me to sell is if the market gets up somewhere up here. Who knows, might get up there. Now we see, we've got 3 hours and 20 minutes. Is it? Yeah, 3 hours and 20 minutes before the US markets open. If I get market accelerating up here or going up here, but I don't want strong bull candles. I want to see bull, bear. I want to see alternating price action. So I can say, okay, the bulls are not that strong. The bears are stopping the bulls. And if we get a double top somewhere within here, then we can look for a lower high. But what if the bulls are so strong that they're not going to allow the double top to be created? Well, what is likely to happen at this stage? The market can accelerate there. There's a higher probability that it goes sideways and creates possibly a double bottom. That's if the bulls are strong. So instead of a reversal pattern, you can see within any reversal pattern a predominance of strong or large bull candles. And if you're seeing that, don't just sell because it looks like a double top. Wait a little bit more. The market will give you information. The bulls are strong. They will accelerate up and break above the high. And if they do that with strength, remember a breakout is breakout plus follow through. Strong candle plus follow through, then you can expect the market to go up further and look for a pullback. That's if the bears cannot create a double top here. My higher probability search in this zone is to look for a double top and then a lower high. So you always need to see the pattern, the double top. Then we look for a lower high, whether we have wedges in it or not, and sell it further all the way down. Hang Seng 50. Okay, Hang Seng 50, very interesting. We are below the low of yesterday. We had a breakout, pause, pretty weak breakout, but pause, doji candle and follow through. We've now had a lower high double top below the low of yesterday. So it's still pretty bearish. We had a gap down on the last opening. If we get up here and create a 2-bar reversal or a lower high, then you need to be looking to short. And you just do your measured move. Your stop is just above the low of yesterday. UK 100. And if you look at the measured move of that first candle of the session, it's way up here. So unless, I don't want to be doing anything in this area unless I'm prepared to put a stop again, a huge stop that goes above the measured move. So it's got to be a stop, if anything sets up there around 23.30, and my highest for the UK is 40. So something sets up, I'm comfortable, but you have to put your stop up there. You can't put your stop within the day's range. That's the high of the day. There is a measured move of the first candle. There is a key level from the US session. So we always look for these key levels from the previous US session. So all these are levels of resistance. So anything sets up here and you say, I want to sell this, you have to put a stop above the levels of resistance. That's the correct place. And if you do that and the market accelerates, by the time it gets to here, you're 1-to-1 and the bears want to take out that low. So you'll still be rewarded quite handsome. S&P 500. Now, S&P 500 is quite interesting. A couple of minutes to go. So again, look for your short opportunities. But the key thing to bear in mind is don't put your stop in the middle of nowhere. It must be up here. What I want to just show you on S&P 500 is on the daily. So this is where we're at. And again, George still thinks the market is bearish based on price action. Based on price action. And that's how I trade, price action. So you can see we're bouncing off that descending trend line. Okay, so that's pretty key. But besides that, if you just look to the left, huge bear candle, just one day, completely reversed 3-4 days, bit of a pause at the bottom, and then we had acceleration down. We got to the measured move there. Okay, double top. And bulls are trying to reverse the market, but they've come off this level here. The bears are defending that. So the bears are saying, okay, now we have a double top. We want to create a lower high in here so that the market can sell off. And let's see if we can test the low of 2022 before the year ends. So in this zone, already in this month, bear breakout, and that's a pullback. I'm already thinking, well, there's possibly a little bit more opportunity. If you look at your leg 1, leg 2, there is the first leg of the move. And there is the top of the pullback. If the bears can take control of the market, they want to sell off to get to here, which is to test that level where the bulls broke out and maybe go a little bit further. So I'm bearish as far as S&P 500 is concerned, and I'll keep looking out for opportunities. Thank you guys for joining us. Marlon, thank you for hosting. Really appreciate it. We will catch up with you guys next Wednesday. on live trading profits same time. Take care. Happy trading. Bye-bye.